Welcome to another deep dive. Picture driving a highly complex, state-of-the-art machine down the highway. You check the dashboard, and the indicators are putting out just entirely conflicting signals.
Right.
Like the engine light is flashing a cautious, urgent yellow, but the fuel efficiency gauge is glowing a reassuring green. And they are both demanding your attention at the exact same time. Do you pull over or do you keep your foot on the gas?
Well, I mean, that is the exact kind of situation that forces you to pull out the diagnostic manual. And that's exactly what we're doing today with the U.S. economy.
Exactly. Our mission for this deep dive is to help you make sense of a stack of very fresh and honestly entirely contradictory economic data. We're working through a highly detailed U.S. economic research report published by Goldman Sachs dated April 16th, 2026.
And reading through this research is, honestly, it's a jarring experience.
Yeah, it really is.
You've got these isolated pockets of surging demand sitting right next to shrinking national output. You know, your forward-looking sentiment surveys painting this picture of booming optimism, but
Then you look at the hard data.
right, the backward-looking production data.
Yeah.
And it tells a story of contraction. When multiple sectors of the economy are sending opposing signals like this, it can feel incredibly noisy.
Oh, absolutely. But before we pull apart those specific mechanics, I want to give you the absolute bottom line up front, the core conclusion.
The big takeaway.
Right. Despite a chaotic mix of strong and weak data points across employment and manufacturing, Goldman Sachs concluded that the broader U.S. economic engine is fundamentally still pulling forward. In fact, they left their first quarter GDP tracking estimate completely unchanged.
Which is huge.
Right. Unchanged at a very solid positive 2.8% annualized growth.
And that is a remarkably stable conclusion when you consider all the volatility under the hood. Sustaining a 2.8% growth rate is a clear signal that whatever localized friction is happening in certain sectors, it just hasn't derailed the macro momentum.
It reminds me of getting a health checkup where your doctor looks at your chart and says, your cholesterol is slightly elevated, but your resting heart rate is absolutely perfect, so you're still cleared to run a marathon.
Yeah, that's a perfect analogy.
You leave feeling relieved about the marathon, but you still need to figure out what is driving the cholesterol up.
Exactly. And to understand how the economy arrives at that marathon level 2.8% GDP growth, we have to isolate those individual vitals. We need to look at three key pieces of data, starting with the friction in the labor market.
Yeah, let's look at that Goldman Sachs labor data because
Yeah.
the numbers here present what looks like a glaring contradiction between who is getting fired and who is getting hired.
Right. So the labor data from the week ending April 11th reveals this very specific structural gridlock. Let's start with initial jobless claims.
Okay.
This metric measures the number of people who are newly filing for unemployment benefits, essentially. People who were just let go from their jobs.
And the expectation from analysts was that 215,000 people would file. But the actual number came in lower. It dropped by 11,000 down to 207,000.
Right.
On the surface, fewer people getting fired seems like our flashing green light. But then you look at the very next data point.
Continuing claims,
Right.
which tracks the people who are already in the unemployment system. They're continuing to receive benefits because they just haven't secured a new job yet.
And this is where that caution light starts flashing. Continuing claims rose by 31,000, pushing the total to roughly 1.818 million people.
So I am trying to reconcile this.
It's tricky.
If companies aren't firing people, but the people who do lose their jobs are getting stuck in the unemployment system longer, what does that actually say about the health of the labor market?
Well, we're looking at a freeze, basically. And it's driven by corporate psychology. What we're seeing is widespread labor hoarding.
Labor hoarding.
Yeah. Over the last few years, companies went through these agonizing periods of labor shortages. It was incredibly expensive and difficult to recruit, train, hire talent. Oh, right, the hiring nightmares.
Exactly. Because of that recent trauma, employers are absolutely terrified of letting people go. They would rather hold on to staff, even if business slows down slightly, than risk not having them when demand picks up. That explains the low initial claims.
But holding on to your current staff doesn't mean you're bringing new people in the door.
Precisely. High interest rates and, well, just general uncertainty mean these same companies are fiercely protecting their profit margins. So they implement hiring freezes. The front door is locked, shut, no new hires are coming in. But the back door is also locked. Very few people are being pushed out.
Which perfectly explains the spike in continuing claims. If you do happen to get laid off, or, if you are a new graduate trying to enter the workforce, you are walking into a market where nobody is opening the front door.
Right. The fluidity is gone. The market is calcifying. And for you listening to this, it means your immediate investment advice regarding your own human capital fundamentally changes.
Right.
It suggests an environment where holding on to your current position and extracting value internally is much, much safer than testing the open market.
Wow. Okay. But if the national labor market is in this state of calcified gridlock, how does that translate to the actual businesses trying to produce goods?
Well, to answer that, we move to the second key piece of data. The Goldman Sachs report digs into regional manufacturing sentiment, specifically the Philadelphia Fed Manufacturing Index for April.
And the data here is just a massive divergence from the caution we just saw in the labor market.
Oh, completely.
This index came in incredibly hot. Analysts were predicting a flat reading of 10.0. Instead, it jumped 8.6 points to land at 26.7.
Yeah. And the Philly Fed is a diffusion index, so it measures the breadth of sentiment, not necessarily the volume of production. A positive number means more businesses are reporting growth than contraction.
So a jump from 10 to 26.7 means a significantly wider swath of manufacturers suddenly feel very optimistic.
Yes. And the new orders component shot up to 33.0, which is the highest level since November 2021. And shipments jumped to 34.0, the highest since May 2022.
Which paints a picture of a regional manufacturing base getting slammed with fresh demand. But whenever demand surges sharply like that, we have to look at the pricing mechanisms.
We do. And the report explicitly notes that both the prices paid and prices received components increased to their highest levels since August 2025.
See, that feels like a red flag. These factories are paying more for raw materials, and they're passing those costs directly on to the consumer. Are we looking at the start of a renewed inflationary spiral?
It's certainly a localized inflation warning. If they have enough demand to justify raising their own prices, they will do it to protect their margins. But there is another data point inside this Philly Fed report that is even more fascinating.
You mean the employment component?
Exactly. Despite new orders hitting multi-year highs, the employment index actually dropped to negative 5.1.
That makes sense.
I know, it sounds crazy.
It sounds like a popular local restaurant where the line is out the door, the kitchen is pushing out record numbers of meals, they just raised all their prices, but somehow they sent a waiter home early.
That is the perfect way to visualize it.
How does a factory have its highest new orders in years while simultaneously shedding workers?
This brings us to the core driver of everything we're discussing today. It's an incredible efficiency paradox. Over the past few years, these firms invested heavily in automation, software optimization, and advanced robotics.
Because labor was so hard to find.
Right. And now they are realizing the returns on those investments. The machines are absorbing the surge in volume. They are structurally decoupling their output capacity from their human headcount.
Oh, wow. So they just don't need the extra hands.
No, they don't. And they're also just sweating the existing assets. Instead of hiring, they push current employees to work overtime, or they lean on temporary contractors.
That perfectly explains the gridlock in the national labor data. If a booming factory with record orders doesn't need to hire, then the people filing those continuing jobless claims are essentially stranded.
Exactly. They are achieving top-line growth without driving job creation. But we have to be careful not to mistake regional vibes for national reality. Which brings us to the third piece of key data, the national industrial production.
Right. And if Philadelphia is the localized green light, the national hard data is the glaring yellow warning.
They do not match up at all.
The Goldman Sachs report shows that national industrial production in March actually declined by 0.5%, missed expectations entirely. And specific weak spots, like motor vehicle assemblies, dropped a massive 4.0%.
Down to 10 million units.
Yeah.
And utilities dropped 2.3%.
So how do we reconcile this? We have massive optimism in Philly, but across the rest of the country, actual factory output and car manufacturing shrank. Is sentiment just totally detached from reality right now?
Well, hard data, like actual output, often lags or contradicts soft data like surveys. The surging orders in Philadelphia in April could very well be the leading edge of a demand wave that will force national production back up in May or June.
So the vibe check might actually precede the physical reality.
It often does. But here is the single core risk you have to watch out for. The report highlights that national capacity utilization declined down to 75.7%.
Okay, for a listener trying to gauge how serious that is, why is 75.7% a core risk?
Because factories have massive fixed costs: property, machinery, maintenance. When you are only utilizing 75.7% of your capacity, you are spreading those heavy fixed costs over fewer units of output.
Which just crushes your profit margin.
Precisely.
Yeah.
And when margins are squeezed by idle capacity, businesses aggressively cut capital expenditure, they stop buying new equipment, they cancel expansion projects, and they certainly don't hire new workers.
It creates a self-reinforcing cycle of industrial stagnation. So bringing it all together, despite the jobless claims paradox, the inflation warnings in Philly, and the shrinking auto output causing margin squeezes, that overarching GDP estimate remains firmly at 2.8% growth.
Right. Because the broader economy, driven by services, tech, and healthcare, is providing the ballast to absorb these industrial shocks.
The machine is finding a way to balance itself. But I want to leave you, the listener, with a really provocative thought before we go.
Yeah, let's hear it.
If businesses are figuring out how to achieve multi-year highs in new orders while simultaneously shrinking their employment numbers through automation and peak efficiency, does the future of a strong economy fundamentally require fewer jobs?
Wow. Yeah, what happens when peak efficiency means cutting out the human worker entirely?
Exactly. If productivity fully disconnects from employment, the traditional mechanisms that distribute wealth through an economy, like wages, will have to be completely reevaluated.
It really is the defining structural challenge of the next decade.
It's a massive question for you to mull over as we track this unfolding economic mystery. Thank you for joining us on this deep dive. Make sure to subscribe to the channel because the analysis in our next deep dive is going to be even more exciting as we see how these trends play out.
There's always more to learn.
Until next time, keep an eye on that dashboard.